Alright everyone, Cowboy Trades here, welcome back to the channel for another update on the market. So finally, this week which has just passed may have commenced the return of volatility to the markets in a major way. In today's video, we're going to talk about the major catalyst behind this weekly 23% rally in the VIX. We're going to be updating the DXY, the stock market. Of course, we'll be updating Bitcoin and the cryptocurrency markets. We're going to be looking at a few new charts and some new economic data pulled from the Bloomberg terminal. We're going to have some new opinions and we're going to discuss the major events which have just occurred in this week, which may be signaling for the end of the Bitcoin and equity market rally, which we've been seeing in 2023. So stay tuned until the end, guys. You're not going to want to miss what we're going to be talking about in today's video, especially at the end. So let's dive right into this. So let's start off with the first topic. What happened this week which made the VIX shoot to the upside? How is this affecting the DXY and the SP 500? The second segment will be regarding the cryptocurrency markets, and the third segment will be regarding how the economic data that we talk about in the first topic has already started to reposition things like the implied Fed funds rate, making potential interest rate hikes more probable in the future. So topic number one, let's talk about it. So there were two main pieces of economic data that came out this week. Number one, we had a quote unquote bullish surprise shock with the unemployment rate falling from 3.6% estimated to be at 3.6% again, dropping to 3.5%. Now, in topic 3, later on, we're going to talk about how this is already starting to reposition things like future interest rates. For now, let's focus on the second most important, arguably the most important piece of economic data which came this week. This was a bearish economic surprise which came from Fitch Ratings, who downgraded the US's long-term foreign currency issuer default rating, also known as the IDR. They decreased it from a AAA rating to a AA rating. Now, this is what sent the VIX skyrocketing 23%. You can basically see where this news came out right here. We gapped all the way up and pretty much the VIX has just absolutely exploded since then. I do want to highlight from a technical perspective, this is something we've been looking at for a while. We have been pointing out that the stochastic RSI, just like in all of these other instances here, has come down to the zero and has been lollygagging for quite some time. We are turning up quite strongly now. In fact, we really haven't had a bullish turn up in the VIX like this since all the way back in January of 2023, where we did go from about 17 all the way up to 30. So I am believing that the VIX is due for continuation and is likely to get more volatility coming back. We have definitely been having a major short squeeze in terms of the volatility index for the SP 500 recently. I think this is going to start coming back in a major way. Now, of course, the DXY didn't respond too nicely to this. However, it wasn't all too bad. We have had a bullish few weeks over in the DXY. We have bounced from this major trend line, which we have been talking about. This trend line's been in place for about 8 years now, and this was previous resistance. This was a SFP swing failure pattern. Once again, swing failure pattern, resistance. And, we've kind of come up and we've held this as support right now. So once again, as we've been talking about in the channel, I do believe the DXY is due to get further continuation to the upside, also partially due to looking at the bond market, which we're going to talk about in topic number 3 later, which is going to further allow the DXY for continuation to the upside. Additionally, with the news that we had coming out this week that the US has been downgraded to a AA rating, the SP 500 obviously hasn't responded too nicely to this. Now, I don't really want to draw technical analysis on the SP 500 right now. I will just load this up on a generic chart we've been looking at for the corporate insider transactions. We've obviously been highlighting whenever corporate insiders have been buying or selling on the channel. And as you can see, they are doing more selling than buying at this moment in time. The stochastic RSI, the S&P 500 really has been defying gravity. The stock has pretty much been up between 90 and 100 for quite some time now. We have had a bearish flip over on the stochastic RSI this week, and we do have a nasty bearish engulfing candle. So the S&P 500 right now still kind of defying gravity. I think this run up to the upside is pretty much done. I do also want to highlight from high to low, we have pretty much reverted into the 786 Fibonacci, got a rejection, and it is looking like we're going to be moving down for the SPX. This is really just basic technical analysis. The main focus of this video is going to be what we're going to be talking about in topic number 3, which is less of a technical perspective, but more of a fundamental perspective to why things like bonds, the DXY, the interest rates are going to continue moving up, and then financial conditions will tighten, etc. We'll talk about these later. Just a brief overview right here. Now, one thing I do want to highlight is, as you know, we have been talking about this on the channel, the S&P 500 has been rallying because of basically 7 stocks. We talked about this before: Meta, Amazon, Microsoft, Apple, Google, Nvidia, and Tesla. These are basically the only 7 companies in the S&P 500 which have been rallying, and pretty much all of the other small caps, which we'll talk about in a second, have been left in the dust. Now, one of the major leaders in the S&P 500 this week has absolutely tanked. This is Apple. You can see that it has been in a very healthy uptrend since January of 2023. It's been holding this support line, holding this support line, holding this support line, and this week, due to some news, Apple is breaking down very strongly right now. And this is one of the major reasons why we are seeing the S&P 500 also take a critical hit, because some of the largest stocks in the S&P 500 are getting hit hard right now. Now, we have been talking about this over on the channel. We've been talking about how these 7 stocks have been pretty much single-handedly holding up the S&P 500. These 7 stocks have accounted for pretty much all of the gains in the S&P 500 this year, and the other 493 companies in the equity market were only up 1% year to date. So this is from a broad perspective on the S&P 500 and the weakness that we are probably about to see in the equity markets. I want to show you a new chart and a new index. This is over on the IWM iShares Russell 2000 ETF. That is a massive mouthful, so from now on, we're just going to call it the IWM. What is the IWM? Well, the S&P 500 is a stock market index in the US, which comprises of approximately 505, something like this. It's not actually 500, it's more than 500. Nonetheless, it's an index comprised of the 500 largest stocks in the US. What the IWM is this is an ETF which grants you access to 2,000 small cap US stocks. So instead of looking at the S&P 500 comprised of Apple, Nvidia, Microsoft, etc., the IWM is showing you the bottom of the barrel. This is showing you, basically the average small cap stocks in the US, which aren't in the S&P 500. Now, as you can see, like I've been saying, guys, the S&P 500 has been rallying, defying gravity, based on the fact that these 7 stocks alone have been promoting all of the gains in the S&P 500. However, for the small caps, they haven't got the AI memo, which all of these other large caps have got. If you look at the earnings reports for pretty much all of the top tech stocks and S&P 500 stocks, if you look at their earnings reports, it's basically a game to see who can mention AI the most amount of times. The more you mention AI, the greater your earnings are, the greater investors are interested in your stock. The small caps haven't particularly followed this memo, and you can basically see small caps are still in a absolutely brutal bear market compared to the S&P 500, which, like we've been discussing, has been defying gravity based on these 7 individual stocks. So I really just want to highlight, in terms of small caps, the market breadth is still extremely weak. The IWM does a great job of showing what most US stocks are doing. Most US stocks are still in a bear market. It's just the upper echelon of tech stocks which are repeatedly mentioning the words AI in their earnings reports, which are causing for the S&P 500 to rally. And a lot of this hype is dying out at this moment in time. We are seeing some of the larger caps start to have a significant topping formation at this moment in time. Potentially, I'll talk about these 7 individual stocks and what my outlook are for them in a separate video. This isn't what I want to talk about today, but yeah, the IWM at a critical level of resistance, taking a turn for the worse this week with a nasty bearish engulfing candle. Now, let's move on to what is happening in the cryptocurrency markets. Guys, so much has changed in the past 9 days since I left. I'm only joking, absolutely nothing's changed. If we're looking at the total cryptocurrency market cap, we're pretty much at the same level as we were last week. It's the same for most of the cryptocurrency markets. Basically, nothing has happened in the past 9 days. Just a very brief update. If we are looking at the total cryptocurrency market cap, you can see the weekly EMA ribbons around here, the bull market support bands. Guys, we've been sitting on these levels since around about the 19th of June. Things are still inherently boring at this moment in time. I still do see the same head and shoulders developing. You can see we're slowly for the past month or so trickling to the downside. I think once we start losing the bull market support bands, weekly EMA ribbons, 200-week moving averages right around here at approximately 1.088 trillion, I think things will start to take a turn for the worse for the cryptocurrency markets. In terms of the altcoins, altcoins are getting hit pretty hard right now. This week, following the news that the US was going to be downgraded to a AA, the equity market started to break to the downside, the DXY went up, bond market went up, and altcoins started to lose the final level of support. This is kind of like what I see foreshadowing over in the total cryptocurrency market cap. The altcoins are just doing it a little bit faster right now. As you can see, the altcoin market cap is breaking beneath the weekly EMA ribbons, the weekly bull market support bands, the 200-week moving average. We're basically losing all of the most important lines of support at this moment in time, and we're kind of in a free fall right now. There's really not too much beneath us in terms of volume. If I pull out the volume profiles and look at this range, we kind of got magnetized to this major area of volume already. If we come over to the most recent rally from this low up to this high, there's not much beneath us. We had a very, very quick and sharp rally to the upside, and there's not much support built out beneath us at this moment in time. In fact, let's come over to the liquidity swings. Is there anything above us? There's really not too much above us in terms of liquidity. There's a lot of liquidity right beneath us. So I think we're going to be magnetized to the bottom of this channel once again. I think the altcoin market is probably going to start moving down to around about the 426 billion mark. That's a 24% drop to the downside, basically coming down to new bear market lows before potentially heading down to right on the dot 400 billion, in which we have this macro 786 Fibonacci, the last line in the sand for altcoins. Typically in bear markets, once you come down and you lose the 786 Fibonacci, that is when you have the final leg to the downside. So really just a quick update in terms of what's happening in the cryptocurrency markets. If we do come over to Bitcoin, everything's been relatively stagnant. You can see, however, this week something has monumentally changed. The stochastic RSI on the weekly time frame is taking a turn to the downside. We're still kind of slowly bleeding out. Ever since US judges ruled that XRP was not a security based on the data that they were presented, we've been dropping from 32,000 down to about 29,000. This has taken a month. It's been very, very slow, very, very stagnating. We are still bleeding out to the downside like we have been talking about, but it's just happening very, very slowly. Now, one thing that we have been talking about on the channel is this fractal, and we're going to talk about a new fractal in just 1 second on the monthly time frame. In terms of the weekly, you can see we have had that bearish flip over in the MACD, which we have been waiting for. We've previously highlighted how in bear markets, when you have a bullish flip on the MACD, it's typically not a bullish sign, it's a sign of overextension. Now, this is only true for bear markets. If you're in a bull market and you have a bullish MACD flip, that typically means that you've had a correction and now you're turning bullish. However, in a bear market, if you are still in a bear market, if you do have a bullish MACD flip, as you can see, it's a sign of buying exhaustion. It's a sign that you've reverted back to the mean and you're ready to push back down to the downside. You can see this beautiful fractal of a bullish flip after a rally, and then a bearish flip, and then this bullish flip after this rally, and a bearish flip, which has just occurred this week. However, I want to talk about one new fractal which we have not previously discussed over on the MACD and over on Bitcoin on the monthly time frame. Now, I want to show you what happened in 2018. In 2018, we were, of course, breaking down into a bear market. We had a bearish structure over on the MACD. We had a massive, massive impulse to the upside. And as you can see, when the MACD flipped bullish right here on the monthly time frame, that was actually a sign that we were overextended, even though we were going into a new bull market and we were due for a very significant correction. In fact, the correction from peak to low was about a 72% drop, making a higher low. And right now, you can see we've had this brutal, brutal bear market. We've had a push to the upside over on the MACD on the monthly time frame. We've flipped bullish. According to this kind of fractal which we've been witnessing, we should be experiencing that same drop back down to the downside. Now, does this have to make a higher low and then enter a new bull market like last time? It doesn't have to. I know this is potentially what the fractal would signify if this does have 100% correlation. I'm not saying that. I'm just saying this is an interesting find. It's just something I wanted to point out. Nonetheless, you know my thoughts if you watch my channel. Nothing's changed. I still do think that we come down for one new bear market low, potentially around about this 14,000, retesting this previous region. Guys, you know already if you've been watching the channel, we've been buying since 25,000. We've been buying at 24, 23, 22, 21, etc. all the way down to the lows around about 16,000. If we do break down to 15, 14, 13, 12, whatever it goes down to, we're going to continue DCAing down at these levels. It doesn't matter if we bottom at 14, 12, or 10. We'll be buying at all these levels. Something like this is what I perceive to happen in the markets. Round about 14 to 12,000. I think that's a very, very fair level, not too bullish, not too bearish. This is still my base case for what I'm expecting for Bitcoin. In terms of the lower time frames, like I said, nothing has really changed. We have, however, over on the daily time frame, if we do look at this tight range, which we have been trading in, we broke to the downside of this very, very crabby structure. We pushed back up on Wednesday, and we have retested this previous support as resistance. So I just proceed to believe that we are going to further drop to the downside. I think my price target's down at 28,250 and the 200-week moving average down here around about 27,200. These are still my price targets. In effect, nothing has changed. And of course, once we start sliding beneath that 200-week moving average, we do have a major CME gap down here all the way at 20,260. So there we go. Those are my thoughts on Bitcoin and the cryptocurrency markets. Let's now dive into a plethora of new economic data. Let's talk about how the major economic events which came out this week are already starting to unfold and affect the markets. So earlier we talked about how the equity markets were affected by Fitch downgrading the US from a AAA rating to a AA rating. In terms of the bond market, this is what happened following that economic news. If we come over to most government bonds, the 2-year not so much, a plethora of other government bonds such as the 10-year, the 30-year, etc. did see breakouts this week. You can see following this news, the bond prices absolutely fell through the floorboards and subsequently bond yields went through the roof. Now you can see right now the 10-year yield wicked all the way up to almost the bull market highs over in the government bonds. If we come over to the iShares TIP ETF, they absolutely plummeted, and they plummeted almost down to the bear market lows. So once again, guys, you know the gist of these. We look at these because these are leading indicators for the rest of the markets. Let's now dive into the rest of the new charts which we have pulled from Bloomberg. So the second economic surprise which came this week was, of course, as we discussed earlier, the unemployment rate dropping to 3.5%. Now, as of 2023, you can see if we're looking at the economic surprise monitor, the housing market and the labor market, these have been the two major factors which have been holding up the economy at this moment in time, allowing for the Fed to raise interest rates further and further. However, if we're looking at the most recent snapshot specifically for the housing sector, this screenshot was taken yesterday following the new economic data that we had for the housing market yesterday. We did have a bunch of negative shocks. Now, I don't want to make content, I don't want to make YouTube videos about the housing market. I don't think any of you are interested in my thoughts on the housing market, nor do I want to make videos about the housing market. So just to very quickly summarize, because I do keep up with the housing market on a personal level, based on the most recent negative economic data shocks that we've got coming in, due to the mortgage rates, due to credit tightness, high delinquencies of credit, house prices, and common sense, I do think the housing market right now is at a critical area, the same kind of level it was in the 2008 financial crisis, in which I think that we are at a tipping point in which it could start to come back down to the downside. Now, the economic surprise that we talked about earlier being that we had a quote-unquote bullish reading in the unemployment rate as it dropped down further to 3.5%. On the channel, we've been discussing recently how this quote-unquote bullish data that's coming in for the job market is not as bullish as you would think. If we're in a bull market, it's in a completely different perspective, but right now we're in a period in which the Fed is tightening, and when we are getting these bullish reports from the job market showing that the economy is still holding up despite the fact that interest rates are so high, this basically just forecasts to the Fed. This lets them know that they can increase the interest rates further and further. So what happened immediately after the unemployment rate dropped down to 3.5%? Well, this caused for the Fed dot plot to reposition and accommodate for further rate hikes. The implied median rate increased to 5.625%. Currently, we're at 5.5%. So while this doesn't 100% add up to 25 basis points, this basically signifies that most Fed participants want a further 25 basis point increase. Now, the Fed funds rates also back up this claim. If we are looking at the top of the screen right now, you can see until we come over to the first meeting of 2024 on the 31st of January, it's not looking like we're going to see any meaningful cuts in the implied rate for the Fed funds. If we are now looking at the bottom of the screen, looking at the implied overnight rate, you can see that once again, this is just the same thing over in a different graph. This kind of shows us that we're not really going to be expecting any rate cuts to come until 2024. I think the Fed are going to increase maybe 1 or 2 more times. I think they're going to hold hostage for the next few months at these higher levels, and then they could start to cut. I don't think, like the Fed dot plot states, that they're just going to raise, and then cut. I think it's more likely they're going to raise, pause, cut. Something like this. This is normally what happens, not always. Now let's tie this back into bonds, because the bond market is extremely sensitive to changes in the interest rates. And this is really why the treasury curves, the yield curves are absolutely messed up right now. Now, this chart over here is the US Treasury yield curve. If you look at the bottom of the screen, you can see different dates in which you could take out different government bonds. There's 1 month, there's 3 months, there's 6 months, 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, etc. And what this shows us is, if you watch my channel, I'm sure we look at this all the time. So for example, this chart over here, this is the 10-year government bonds. This is currently at 4%. So if we come over to this chart and we are coming all the way over to the 10-year yields, this just shows us the rate of the 10-year yields. As we've been discussing on the channel as well, if we come over to the 2-year government bond yields, if you take out a 2-year yield, this will yield 4.77%. So if we come over to 2 years, look at this sweet spot right around here. This is basically, right around here, sorry. This is basically what it shows us. It shows us the yield curve, how much you will get for different bonds for holding them for different periods of time. Now, typically, a yield curve does not look like this. A yield curve typically slopes upwards. Why does it slope upwards? Well, it's to compensate long-term bond holders. Remember, the bond market is the market which finances the government. They are the market which lends to governments, in which governments can use that money to spend. And then, basic Keynesian economics, the government's like, okay, if we print $10, this will cause $11 worth of GDP. That's the whole Keynesian economics of printing money. I'm not a big proponent of that. I'm more of a proponent of Austrian economics. But nonetheless, back to the picture, treasury yield curves do not look like this unless they are basically a harbinger of a recession. Now, typically yield curves are positively sloped, and this is because yield curves benefit long-term holders. Basically what this means is, say for example, if you take out a 1-year yield, maybe you'll get 4% for lending for 1 year. However, if you're doing a 2-year, maybe you'll get 4.2%. If you're doing a 10-year, maybe you'll get 5%. If you're doing a 20-year, maybe you'll get 6%. The whole picture of this is the longer you lend money in the bond market, the greater you should be compensated. But in times of massive economic uncertainty, where short-term risk is absolutely prevalent, you see short-term risk outweighing long-term risk. And this is why you're seeing such great yields for 1 year, 2 year. This is why you're seeing Fitch downgrade the US to a AA rating, because the short-term risk is exponentially high, which is why there is so much potential yield in the short term compared to the long term. The whole market sentiment behind this is the US will probably be fine in 20 years. It will probably be fine in 30 years. So we don't need to compensate you too much if you're investing in the long term. But if you're investing in a year, maybe 2 years, maybe 3 years, maybe 4 years, things are very, very high risk. As we've been talking about, looking at the probability of a recession on this channel, it's looking relatively high. Now, JP Morgan can come out and say, we don't predict a recession is going to come. I think based on analysis that we've been looking at, on the Bloomberg terminal, looking at the probabilities on multiple different sectors, I think it's very probable that we are going to see a recession. Now, this is very, very similar to the US 10-2. Now, you may be familiar with this, especially if you're a veteran of the channel. You would have witnessed me talk about this many, many times. The yield curve, when this is inverse, when the yield curve is dropping to the downside, this is a sign that short-term risk is very, very high. Just like it was in the Gulf War, just like it was in the 2000 dot-com crisis, just like it was in the 2008 subprime mortgage crisis, just like it was following that event that we all know that happened in 2019, and just like it's happening right now, the yield curve is inverse. This is typically a harbinger of a recession. This is really just another way of looking at this yield curve over here. Yield curves are positively sloped unless they're negatively sloped. If they're negatively sloped, short-term risk is very high. Bond market is predicting a recession. You can see the same thing in this photo over here. This is basically a yield curve in a 3D model. This displays the date of some of these bonds, the rate that you can get over on the y-axis here, and also on the x-axis down here, it is the duration of these bonds. Now, as you can see, this is the same as this one over here. You can see that exact same plot. You can see the duration of some of these bonds and the yields that you can get. Now, as you can see, right now because this is negatively sloped. Short-term bonds are offering very, very high yield right now. Long-term bonds, not so much. This is what we're seeing in the yield curve right now with this negative slope. It might be a little bit difficult to see in the 3D model. I think it's very, very clear in this 2D model here. There's a very, very nice sweet spot right here on the 1 year and the 2-year yield, where you could be locking in large amounts of years in the next 1 or 2 years. For example, 2-year government bonds currently offering 4.7% yield per year. So you can very clearly see there is a beautiful sweet spot right here in terms of the yield. If you don't think the US is going to break into a recession in the next year or so, then this may be a very, very tempting offer to take out some government bonds in the 1 or 2 year basis. While I personally do believe the US is due for a recession at some point soon, I may start to look at locking in some of these bonds at some point soon. Not really something I cover on this channel, I know, but nonetheless, you can see there is a very, very nice sweet spot right now for taking out some short-term risk trades over in the bond market. And there we go, my friends. That's what I wanted to talk about today. That's the new economic data which came out this week, which shot volatility to the upside. These are the new charts that we are currently looking at this moment in time. This is the new data. These are my new thoughts on what is happening right now in the markets. Like I said, this has been a very, very pivotal week. Not so much in terms of the price developments, especially not for Bitcoin. We are still very much in a crab market. We're still very much trending sideways, but with these new very important economic developments, with this massive, massive spike of a 23% increase in 1 week in the VIX index, I think volatility is about to return in a major way. And with this, I do believe that Bitcoin and the SP500, I do believe this fairy tale rally is now over. So for today, my friends, that's all I've got. As always, you know what to do if you enjoy the content. If you missed me, make sure to let me know down below by leaving a like and a comment. Share the videos with your friends. This really does help boost me over on the YouTube algorithm. If you miss me so much while I've been away for the past 9 days that you want to hear more of me, make sure to follow me over on Twitter. Make sure to follow me over on Twitter at 618_cowboy. Make sure to come and join the Discord. If you head over to my YouTube, click on the About section. You can find the invite to my Discord down below. Sometimes the markets are very, very boring. When they're trading sideways like this and they're doing absolutely nothing for weeks on end, I don't want to make daily updates because I really do want to cram as much value as I possibly can into each and every single video. If the markets are trending sideways, I don't always have something to say every single day that's worthy of a video. So regardless, if you do want to hear more of me while there's nothing major going on in the markets, I will post some minor things over on my Twitter at 618_cowboy. I will still be active over in my Discord. Over in my Discord, I've got a specific channel in which you can go and ask me questions, #AskCowboy. If you want to go and ask me questions, if you want to go talk to me, if you want to go hear my thoughts on the markets while I am away from YouTube, you know where to find me. For today, my friends, that's all I've got. It's been your boy Cowboy Trades. I'll see you in the next one. Do you want any altcoin updates tomorrow? Let me know down below. It's been your boy Cowboy Trades. I'm out, my friends. Peace.